Dow 40,000. CPI coming in a little bit better than expected. Do we have Fed presidents declaring victory? Do we have a market set to rip higher or lower? Of course, we're going to talk to the one and only Mr. Dan Bird. We are having some technical camera issues, so we're just going to look at the desktop. Dan, how you doing, buddy?
I'm doing good. Yeah, I don't, for some reason, Zoom wasn't finding my camera. I don't really know why that happened, but
It's okay. The
I'll work on,
conversation is why people are here.
yeah, I'll work on it after this and see if I can get it fixed. But
There you go. Well, why don't you
at
tell us
least,
where,
at
where
least the
we're at?
mic works, so we can have a conversation.
That's right. So as we wrapped up last week, we did see the Dow close above 40,000 for the very first time. I think S&P 500 also hit a record last week. So where are we at, and what do you see coming?
So first, let's talk about that 40,000 number, which is really an artificial number. I think we've talked about this before on this channel. The Dow and the S&P and the NASDAQ, but especially the Dow. The Dow continually rotates names in and out of the Dow. So the Dow that we see today is not the same Dow that we saw 20 years ago or 30 years ago or 40 years ago. It's a different Dow. So what they do is they look at the laggards, they remove them, and they add in new companies that are growing more rapidly and maybe more representative of the new economy. And as a result, the Dow just continues to go higher. So it's not a magic number. That 40,000 is interesting, but it's not a magic number. The Dow should continue to go higher because they will continue to cut out the bad ones and add in the new ones.
Got it.
So there's nothing magical or surprising about that 40,000 number.
Okay.
The S&P hit 5,300, which is what a lot of people were prognosticating at the beginning of the year, that it should hit 5,300 by the end of the year.
Yep.
And it's already there. In fact, I'll show you the S&P chart. There it is. There's the 2021 all-time high. And,
wow.
And there's the new all-time high. So Wednesday, we broke above that all-time high that we had hit back here in March. April was a big sell-off, which we talked about, and I was kind of expecting. I thought we'd get a 3 to 5%. We had about a 5.5% decline before we started back up again. We went up to this 50-day and that resistance level that I pointed out, pulled back from it, but then we went right through it.
Yeah.
Which is what I thought we would do because the two candles before that were very bullish candles. If you can see those, you know, the Dow, I mean, the S&P sold off during the day after 2 down days. Sold off during the day, but ended at the highs. Actually ended higher than it opened. The second day is a very small one. You can barely see it, but same thing happened. It gapped up, sold off during the day, and at the end of the day, ended at the highs. So both of those are very bullish signals, and they both happen right at resistance. So I was pretty sure it was going to break through, and plus all the momentum indicators also were getting ready to turn higher.
Got it.
So it didn't surprise me that it broke through that resistance, and then we hit the previous high from April, and we went through that. So now we are at new all-time highs.
Okay.
And after hitting that on Wednesday, nice long white candle, which means it ended the day at the highs of the day. So the only reason it didn't go higher is because the market closed.
Right.
And the next day it went higher and then pulled back. And on Friday, it basically didn't do anything. Just sort of went down a little bit, came back up, and ended almost exactly where it started.
Yeah.
So it opened at 5303.10 and closed at 5303.27.
Yeah, that's not doing much. There you
Right.
go. Well, a lot of stuff happened last week. Probably the most market moving was CPI and maybe retail sales.
Yeah.
What'd you see in CPI? I forget, was this the month that you and I were concerned about because the base effect was so small?
No, that's June. That's next month.
Next month. Oh, I was off a month.
This one, actually, I thought that it would probably come in lighter than the previous month. It came in at expectations. So This one here is this one here actually drops off in the June report,
Right.
which is a small one. So this is June. So this is what it currently looks like.
Okay.
And pull that back a little bit. So there's the one was just reported last week.
Yep.
It was higher month over month, but this is the big one that dropped off in last week's report. And this is the small one that's going to drop off in June.
Got it.
So that's what was concerning us. And interestingly, in June, the CPI comes out at 8:30 on June 12th, and the Fed meeting is at 2 o'clock on June 12th.
Oh, great. Well, woo, fireworks.
Same day. So that will be a big one. So this one I thought we would come in, and I actually said it the week before last when I did one on my own. You were out. I said that I thought CPI would probably come in around 3.4, right at what it was forecast, a little lower than the previous month, and that's exactly what it did.
Nice.
This is the one that we're worried about, the June one. But one thing that's happened since then is commodities.
Commodities, yeah, they've rolled over.
Yeah, commodities are falling rapidly.
Ooh, look at Dr. Copper.
Wow. Yeah, copper's taking off, which is actually good. Usually goes up when the economy is doing well. So that's a good thing. The other ones, though, like food, you can see how food was parabolic.
Yeah.
And what's highlighted here is what will be reported in June.
Correct.
So we're about halfway through the month. If this continues to drop, especially gas and oil, which look like it's kind of flattening out right now, but if they continue to drop and everything else kind of drops, then that will help.
Okay.
Yeah, that'll help CPI. I don't think it's going to be a dramatic lower number, but we could come in at 3.3 in June.
That's much better than you and I were fearing 2 or 3 weeks ago when we're like, June could go up.
Yeah, we were fearing that it might give the Fed ammunition to raise.
Right.
But I don't think that's going to happen now.
Yeah. I think the Fed's done. The Fed can't go up, right?
No, I agree. I don't think they're going to go up. The question is, when will they cut?
Yes.
Any thoughts on that?
Yeah, I'm still calling November, right after the election.
You know what the Fed meeting, you know what day the Fed meeting is in November?
I think, well, it's Wednesday and the election's Tuesday. So the day after the election?
Okay.
I don't remember.
I think they might wait till December.
They could,
but it's all going to be dependent on this, which I've been saying over and over again.
Jobs. Yep.
Unemployment rate. So unemployment rate came in at 3.9. I haven't updated this.
No, yeah, 3.9.
Yeah, this actually came in at 3.9, so it's ticked up a little bit. Right here, currently at 3.9. But it didn't really change the SOM rule.
Yeah, 4.2 is still the magic number.
Yeah, 4.24. Let's call it 4.25.
Okay.
Somewhere in that neighborhood, let's say.
Yep.
So if this continues to go up and it goes up quicker than expected, then the Fed could cut in September.
Yeah, I logically speaking, you're absolutely correct. I can't see them cutting in September unless
they don't want to. They don't like to do it before an election.
No, they don't. Yeah.
So we'll see. I mean, what if this goes to 4 or 5
by September? Yeah. Oh, they're cutting. Yeah. If it's 4 or 5 by September, yeah, they're cutting.
Right. So you can see what happens when the red line crosses the green line.
Yeah, so it goes parabolic.
Yeah, it's 3-month moving average crossing the 12-month. When that happens, it starts to ramp up very rapidly. And that's correct. That's what the Fed does not want to see happen. So if this goes up slowly like it has been, that'll be a good thing. If it starts to ramp up more quickly, though, before September, then I think cuts are on the table for September.
No, I agree with that. Logic, yeah. Yes, that logically holds.
So this one's the key. This is the one to watch. And for those on my website, it's right at the top in the upper left on the charts page is recession watch box. None of these three components have triggered yet.
Nope.
So I still think a recession will probably come in Q1 next year.
Oh, okay.
Next year, 25.
Yeah.
Yep.
That could be.
And I think 25 is going to be a cyclical bear market.
Mm. Now, why do you think that?
Let me see. This is the channel we've been in since the bottom in 2009. And the secular bear ended officially in 2013 when we finally got above the highs from 2000 and 2007. So that's the channel we've been in. We're close, but not at the top yet. And this is a weekly chart, so this can take some time to get there. So I think we're going to the rest of this year. It's an election year for various reasons that I've outlined before, both the election year as well as the January effect and lots of other things. I think we're going to continue higher, and we'll be higher by the end of the year. It won't go straight up. It's going to be choppy between now and then, but I think we'll be higher. But then we're going to be at the top of this channel.
Right.
And a cyclical bear like we had in 2022, you can see we actually broke out through the top of the channel in 21. And then the cyclical bear took hold for most of 22 until October and came back down to the midpoint of the channel. And I think we might see something like that in 25.
Okay. Got it.
And then we'll start back up again. And then in 2029, all hell will break loose.
Yeah, you've been talking about 29 for a little bit now, so yeah.
Yeah, this is the long-term secular bull and bear markets.
Yep.
We're in the secular bull. They typically last 18 to 20 years. This one started officially in 2013, or you could count it from 2009 if you want, which was the bottom. But it didn't break out until 2013. But regardless, if you add 18 to 20 years, we're somewhere in this range, 2029 to 2033, somewhere around then. And I think that is going to be the point where our debt becomes overbearing on the economy.
Okay.
In other words, the interest on the debt is going to be significantly higher than what we should have to support a growing economy.
Yeah. Well, it's got to become a problem eventually. You can't keep growing $1 trillion every 100 days. That eventually breaks. Just no question.
Yeah, exactly. It's a new button I added to the website.
No, look at you.
If you just want to watch the national debt rising, it's kind of depressing.
Wow, look at all that
right
stuff.
Up there in the upper, you can see how fast it goes up just in the time that we're talking. Yeah, it just right there went up 100,000 just in the short time we just talked about this.
Oh, great. It makes me feel take that off. I'm getting a heart attack. Well, you know what? Something else that's happening next week is we get Nvidia King AI report.
Yes. So that is going to be, and I said this in the newsletter. For anyone that's interested in getting the newsletter, it's free. Just go to this breakpointtrading.net site and click on this button right here, and you can get the free newsletter. If you want to be reminded, it's available. Just go down to the bottom of the front page and register down here for the $0. Won't ask for a credit card, and we don't share emails, so you shouldn't get spam from it. But then you'll get a reminder that the newsletter is available. Or if you want all the content, it's $99 a year. But I said that Nvidia is what will move the market next week.
Yeah, Wednesday.
Yeah, and we'll take a look at Nvidia. It's pretty interesting. I actually said this also in the newsletter. There's the chart. And if I extend this line right here, what we see is a triple top.
Ooh.
1, 2, 3.
And for those of us that don't know what a triple top means, what does that mean?
So a triple top it's a resistance level. The way you can think of it, and this is really how you can think about technical analysis in general. It's a visual representation of investor behavior. So it went up here, about 950. So this is back in March, hit 950 and pull back. So that was the limit of all of these buyers, everybody buying after earnings. That was as far as they would want to take it, 950, and then people started selling. And then it started coming back again. Well, when it came back, all the people that bought right here at the top just wanted to get out at break even. So it came back there and they started selling. And then they started selling and actually sent it lower than it had before. Well, then it recovered, started coming back again. Well, guess what? All the people that bought at the top right here, guess what they want to do? They just want to break even. Right? So we've hit it again, and now they're taking their profits. It's just before earnings, so it could go down another couple of days. Might come down here to the 21 and 50-day moving averages, and then we'll see. We'll see what happens with earnings.
Do I remember right? You had a stop on at what, 9.25 or 8.25?
I had a stop at 8.25 on half of my position, and that got stopped out.
Yep.
The other half I still have from way back here, actually way back here at 300.
Nice. Okay.
So I'll continue to hang on to that. We'll see what happens. Now, if they announce a split, it's going to take off. If they announce blowout earnings again, it will take off. If they announce really good earnings, but poor guidance, lower guidance, it'll sell off.
And haven't we seen a lot of that from tech companies, at least this go around? Now, obviously, Nvidia is in its class by itself. So, but a lot of people have been hitting earnings and weak guidance. Yeah.
So there have been quite a few, actually. Yeah. Hit good earnings and weak guidance. So they sold off. But in general, the earnings season hasn't been too bad, really.
No, that's true. Yeah.
It's kind of winding down now. Nvidia is one of the last ones, really, one of the last big ones.
Let me ask you about one more, if you don't mind.
Sure.
Palo Alto Networks reports Monday. They're often a tell for me because they're in the cybersecurity space. I think it's PANW, I think. I could be wrong.
Yeah, that's right. Okay, so they report on the 20th, Monday, yeah. Probably after the close.
After the close Monday, yeah. So you can see what happened last quarter. They basically hit but gave weak guidance.
Weak guidance came down, and one of the people, companies give weak guidance, especially strong companies and ones that have good management, like Palo Alto. They give weak guidance so that they can beat it the next time.
Right. Okay.
So they might just beat. So one of the things that I look at when I look at things just before earnings is how does the momentum indicators look? And this one's continuing to go up and has not rolled over yet. But more importantly, how are they doing versus their peers?
Right.
So you can see when they reported last time, they dropped way down and have been underperforming their peers up until middle of April. And then they actually really the beginning of April, and then they slowly started to outperform their peers again. So that's a good thing. In general, I think probably it's going to be average guidance or average earnings. And I think they'll probably maintain their previous guidance. They won't lower it again. They'll maintain what they said last time.
Okay.
So that could go either way, really.
Sure.
But Palo Alto and Nvidia in particular is going to drive the market next week.
No question. No question. I think Palo Alto Networks, again, is one that I watch because obviously it's in the cybersecurity space. You and I played there for a while.
Right.
And we both know it's the last software to get cut from budgets.
Yeah.
So just one of the reasons I watch them.
That's true. And it's a strong company. I mean, it's done well for quite a while. Absolutely. If we look at the Magnificent Seven, this is basically just the trend chart. And I'll show you the overall trend chart in a second, but all of them are short-term bullish. And even the midterm is starting to turn bullish. These ones that are bear are close to turning into bulls.
Oh, wow.
So this is all the Magnificent Seven plus Netflix, AMD, SMCI, and Oracle down here.
Very cool.
If we look at the bigger picture of that market bias matrix, this again divides things into indexes, sectors, industry groups, intermarket relationships, which I want to talk about in a second, commodities, metals, and currencies. And last time we talked, which was 3 weeks ago, right? Last week was Mother's Day, and you were out the week before. So it's 3 weeks since you and I have talked.
Correct.
When we talked the last time, almost everything in this middle column was red.
Yeah, I remember.
And a lot of the things in this left-hand column, the short term, were also red.
Interesting.
And if you look at this chart right here, which is an overall chart, so the bottom right here is May 2nd. The last time you and I talked was May 1st. All right. So this was heading down and all these things were red over here. And you can see the day over day, week over week trend.
Yeah, look at that.
Right. So here's May 1st right here. This was all red.
Yep.
So there's May 2nd, May 3rd, 4th, 5th. You see what it's done ever since. So everything is turning bullish and all of these, and every day, I do this every day. Every day when I do it, I'm adding, well, a lot back here. I'm adding more green bullish squares. That means it changed that day.
Right.
So on Friday, the energy short term changed from bear to bull on Friday.
Wow.
So each day these will all get erased and new ones will pop up depending on how it's changed each day. But what I've noticed that when I do this is I'm doing a lot of bulls and not very many bears.
Interesting.
So, and you can see over here, the orange line is the short term, the gray line is the medium term.
Yeah. That's
usually how it should look. Short term rolls over first, and then the medium term, long term is pretty stable. But now the short term has crossed above the medium term, and both of them are heading back up to the long term line. When it gets back there, things kind of flatten out, and then we're close to a top again. But right now, everything looks very bullish, except for right here, intermarket relationships. There's a bunch of red ones in here. That is very concerning. And let me show you why. I go over here and I actually added a new chart for intermarket relationships. I think it's this one. Yeah. All right, kind of busy and bright, but this chart basically, that all starts at the same place. So these are performance charts. So it goes back 3 years.
Yep.
So everything starts at 0.
Yep. Got it.
So as it moves forward, they're all relative to each other, starting at 0. And the thing that I will call your attention to is the white line in the background. That's the S&P. So you see the white arrow here?
I do.
That's the trend of the S&P going back to October, which was the low in October. Okay.
Yeah, I've got you. Yeah.
The other ones are intermarket relationships. So if we just look at growth, this is growth versus value. This blue one.
So trending down.
Yep. Yeah, if it's turning down, that means value is outperforming growth.
Right.
Or growth is underperforming value.
Fair.
If it goes down. The pink one is NASDAQ versus the S&P. NASDAQ is underperforming the S&P. Green one is discretionary versus staples, things we would like to buy and things that we have to buy.
Yep. Yeah, look at that.
That's really going down. Discretionary is underperforming staples. That means people are pulling back from buying things that they would like to buy.
And only what they have to buy. Yep.
Only what they have to buy, like toilet paper and toothpaste.
Toothbrush. Yep. Yep. Yep.
Dow transports versus industrials. Heading down. And then the last one is Russell versus the NASDAQ 100. So it's basically, think of that as small mid caps versus large caps.
All right. Flat.
That's just kind of going sideways. Yeah, kind of flat. But these are the ones that concern me. When
they should. Yeah.
Down when the market is going up, that is a negative divergence. And just to be clear, because I've had this question from quite a few people saying, "Oh, isn't there a negative bearish divergence on such and such?" Well, it's only a divergence if it's going the opposite way of the overall market.
Right.
If this is just going down and the market's going down, that's not a divergence.
Correct.
That is what it's supposed to do. So when everything, you can see the S&P back here, when everything was going up, all of these things were going up too. That's what you want to see. You don't want to see a negative divergence like this.
Got it.
So that concerns me. And last time that really happened was in 2021, just before the 2022 bear market.
Hmm. Oh
So
yeah, I like that. Yeah.
this does not mean that we're getting ready to have a big crash or a bear market or the market's going to head lower. It's not what this means right now. It's just a cause for concern.
Mhm.
It just means that, it looks like there's rotation out of growth and into value. And if it was isolated to just a few sectors, then it would definitely be a concern.
Right.
But right now, there is huge breadth across the market. If I go over here to the breadth chart, you can see right here, there's the NASDAQ advanced decline line. Here's the New York Stock Exchange has just broken to new highs, new 52-week highs. Here's the large cap, new highs, mid cap, new highs, small cap right at new highs.
Wow.
So everything is going up together.
Hmm.
If we also look at the sector performance, this is just for one day. So it doesn't tell you too much just for one day, but the primary thing that I look at here is how many of these sectors are outperforming the S&P.
Right.
Anything that's above the S&P line is outperforming. So we've got a combination of aggressive sectors and defensive sectors. Communication services and consumer discretionary is in there, but we've also got some defensive sectors like energy, healthcare. So it's a mix.
Right.
If I only saw defensive sectors up here, I'd be really concerned.
Right.
But right now it's a mix. If we go out
Okay.
1 week, here's 1 week, every single sector is green except for industrials.
Hmm.
Right? And we've got technology and healthcare, both an aggressive and a defensive sector outperforming the S&P. If we go out 1 month, now everything's green.
Yeah.
Right? Again, the ones outperforming is a mixture. Got the NASDAQ and technology, but you've also got utilities, which is the most defensive sector. But it's a combination. So going back to what I said before, this chart is concerning to me, and it's something to watch, and we'll watch this as we do this, week over week.
Very cool.
And I do have a concern about it. However, there is very wide breadth in the market as well. So that I think is going to keep it going for a while. I think that we're going to do pretty well in the next month or two. We'll talk about that in the next section when we talk about should we sell in May and go away.
Yep.
And then the end of the year, we're going to be higher. And then next year, I think we're going to have another cyclical bear market like we did right here in 22.
Very, very cool. This is all great information. Do me one more time. Show the website where they can get the newsletter.
Sure. It's breakpointtrading.net. And just click on this button right here. And the newsletter comes up with the cartoons.
Always love the cartoons. Well, Dan, you are amazing. Like you said, we will get ready for round 2. Sell in May and go away. Thanks, buddy.
Sounds good. Take care.